Hello everyone. In this video we're going to go through just the topic of something called LIFO Reserve. Basically, the general idea here is that many companies use FIFO internally and then LIFO externally, right? And so what happens is that FIFO, the reason that companies do this is because FIFO is more logical. It's just easier to keep track of, right? Like first in, first out, just kind of like conceptually, or just like if you think about the way a grocery store would sell its food, right? You would hope that they're selling the first items that they get first because those are going to expire first. And so just from a logical standpoint, we can kind of understand FIFO more easily, okay? So from an internal perspective, a lot of times companies just use FIFO because it's easier, okay? And also computationally and administratively, it's easier, okay? Also, but the issue is that LIFO saves the company money on taxes, okay? And so there's this tension of like FIFO is easier to use, but LIFO saves us money on taxes. So companies, a lot of times, they just use one internally and then the other one externally. So FIFO internally, LIFO externally, okay? So if you have two different inventory methods, then companies must have an account that reconciles between these two different inventory systems or methods, okay? Because otherwise, if you're saying, oh, okay, this is our account on FIFO basis, well, when we have to report externally to our stockholders and things of that nature, we're not going to know what the LIFO basis is. So we have to actually record that in an account, okay? So what we do is that we have something called the LIFO Reserve, which is the difference between the inventory method used for internal reporting purposes and LIFO, okay? In the account, allowance to reduce inventory to LIFO is used for the LIFO Reserve. All right, this is just a quick introduction. We are going to see this in a problem in just a minute, but just to get familiar with the terminology, LIFO Reserve is the difference between the inventory method used for internal reporting purposes and LIFO. Okay, so if for FIFO, if the value was $5 and then LIFO, the value of the inventory was $2, well then the LIFO Reserve would be $3, right? Because it's just the difference between the two. Okay, now the LIFO effect is the change in the allowance to reduce inventory to LIFO each year. Okay, and we'll see how that plays out as well. So it's just the change in that account that we use for LIFO Reserve each year. Okay, so now we have an example. It says XYZ company began operations January 1 of 2016. The company uses FIFO for internal reporting purposes and LIFO for external reporting purposes. Company has the following data available for 2016, 2017, 2018 for its inventory. Okay, so then we'll see that the date, the LIFO value, the FIFO value are all given, and then we have a bunch of different dates. And then we have to prepare the journal entries for XYZ company for basically 2016, 2017, and 2018 related to its inventory. Okay, so we're making journal entries for those 3 years. Okay, so basically looking at our chart, our beginning inventory as of like our first day of operations, right, would be 0 and 0. Like we wouldn't have inventory like the very first day we start, right? That would not make sense. Okay, but then at the end of 2016, we see the LIFO value is 35. The FIFO value is 45,000, okay? So the LIFO value is less than the FIFO value, okay? That means that so whenever we have inventory, right, whenever we have something that we purchase, right, whenever we have inventory that's purchased, it either goes to cost of goods sold or it goes to our ending inventory, right? Those are the only two places it can go. Either we sell it or we have it on hand at the end of the year. Right, selling it would be cost of goods sold. Having it on hand at the end of the year would be ending inventory. Okay, and so if you have something like FIFO that's higher than LIFO, that means that your LIFO cost of goods sold is higher than your FIFO cost of goods sold. Okay, and that should make sense, right? Because if we have less, right? If we had something like, and again, this is just making up numbers just to demonstrate the concept, but let's say that, in 2016, we bought 90,000 of inventory, okay? Under FIFO, if we have 45 in ending inventory, that means our cost of goods sold is 45, right? But if under LIFO, we have ending inventory of only 35, that means our cost of goods sold must be 55, right? It must be higher because we have less in our ending inventory, right? And so that's important to notice because then that's going to make an impact on our journal entry, okay? So basically, the way to record this journal entry, right? If we're on the FIFO basis and we're trying to move over to the LIFO basis, then we need to record 10,000 of additional cost of goods sold, right? Because we can see up here that our cost of goods sold under FIFO method is 45, but our LIFO method's 55. So to correctly state our accounts, we'd have to debit cost of goods sold for 10, right? And again, these are made up numbers. They would work with any set of numbers you would make. It's just to demonstrate the concept, right? But to get our cost of goods sold properly stated, we have to debit cost of goods sold, okay? Then we have allowance to reduce inventory to LIFO, okay? That is what we call the LIFO reserve, okay? So that's $10,000 as well, okay? So it says the difference between the inventory method used for internal reporting purposes and LIFO is the LIFO reserve. So in this case, the LIFO reserve for the first year is $10,000, okay? It's $10,000 because that's the difference between these two numbers, right? Okay, then if we talk about the LIFO effect, well, that's the change in the allowance account, okay, the allowance account, okay? So if we were to just draw out the allowance account, which is going to help us for the next couple of years, we just want to go ahead and do this because it's going to help us for the next couple of years, okay? The allowance account starts at 0, okay, but we want it to end at $10,000, right? Because we know that's the difference between the two accounts, okay? And this allowance account is going to reduce the balance in the inventory account, right? Because this is basically what's going to happen is that you're going to have your ending inventory on your books at, say, 45,000, and then you're going to have less the allowance account at 10,000, and then that's going to get you to the $35,000, okay, that we would have under LIFO, okay, because we would say this is the FIFO value, right, less the allowance account gets us to our LIFO value, okay. So we want the allowance account to end at 10,000 because that's what we need, and so to make our inventory balance at FIFO, okay, on our balance sheet. So then the LIFO effect is the change in the allowance account each year. It's the change. So the change is 10,000, right? Because we went from 0 to 10,000, okay? So that's the first year. The second year, we see the difference is 15, right? The $15,000 difference, again, that is the LIFO reserve for the second year because it's literally just the definition is just the difference between FIFO and LIFO in this case because it's the difference between the internal and external reporting methods for inventory, okay? Then we have to think, okay, well, we need a balance of 15,000 at this point, right? Because if we have 80,000, right, if we think about the same format as above, we have 80,000, well, to get to 65, right, we would need to subtract away 15 in our allowance account, right? So that means our allowance account has to end it with a balance of 15,000, okay? So that means that we need to credit the allowance account for 5. Right, so we credit the allowance account for 5, and then we need to debit cost of goods sold to increase cost of goods sold. Okay, now, why would you not do 15? Well, the reason you would not do 15 here is because you already have 10,000 from last year, right? So if you were to do 15 as your credit here, then you would actually end up, if you did 15 there, you would actually end up with an ending balance of 25, right? Which if we did 80 minus 25, we'd have 55, not 65. Right, so just be careful and remember, okay, well, the first year, yeah, it's going to be the same. It's going to be $10,000. It's going to be the full amount. But the second year, we have to remember we've done stuff in the previous years. Okay, so then this year, the LIFO effect, again, it's the change in the allowance account. So this year, it's this, right? It's the 5,000, okay? The first year was 10,000. This year, it's 5,000. Then at the end of the next year, for 2018, we see that the difference is 5,000. For the LIFO reserve, okay? So in this case, we actually want to have a $5,000 credit ending balance, right? Because that would reduce 75 to 70. Okay, so we actually need a debit allowance, okay, for 10,000, and then we need a credit cost of goods sold to reduce cost of goods sold by 10. Okay, and then this would be the LIFO effect. The $10,000 debit would be the LIFO effect for the last year. Okay, so that's basically this concept. It's not too much. It's just a little bit of a weird concept, so it might take a little bit of time to sink in, but that's the end of this topic, so I hope that helped.